there's absolutely upside potential in the gold price. I mean, just do the math on the amount of gold that the U.S. says they have versus the amount of debt outstanding. And when I say debt outstanding, I'm just talking about on-books debt.
Mm-hmm.
I'm not talking about Fannie Mae, Freddie Mac, Ginnie Mae, all the loan guarantees, Medicaid, Medicare, all the guarantees. You're over $200 trillion. But if you just use the 37 trillion divided by 8,400 tons, the number you're looking at, if we had to pay our debt off in gold, we would have to price gold at about $135,000 an ounce. So there's tremendous upside to gold, but there's, in my mind, at least double the upside in silver versus gold. So, I mean, this term was coined years ago, but silver is going to be gold on steroids.
Wow. And yeah, gold has been at this, I mean, we've seen this consolidation play out. We've got the gold chart here laid out. We've been consolidating for roughly, since end of April. So about a month and a half or so. And if you look at some of these prior patterns here, prior consolidations of gold, this one lasted from September all the way out until, let's call it January. That's about 4 months. The one before that lasted from April of last year to August. I mean, wow, seasonality is right there, right? The consolidation happened exactly at the same time. Before that, it was October, still, somewhere around the time of the next year, right? October all the way out until February, another 4 months. So if history stays true, if we stay true to history, this thing is looking to break out sometime in August. Would you disagree with that? Would you agree with that? What's your kind of your prognosis in terms of?
Yeah, I'd agree with that. But if you look at the fundamentals, if you look at what's going on geopolitically, I mean, on any given morning, you could wake up and gold's up $100, $200, never to look back. I mean, if we woke up one morning and found out that a tanker or a couple tankers hit mines in the Strait of Hormuz, what's that going to do?
Right.
That will break confidence. And God forbid should we wake up one morning and find out that a aircraft carrier got sunk.
Mm-hmm.
I mean, that would be a disaster because in the past, the dollar has always been the safe haven for foreign monies. What happened, if something happens that breaks confidence and the dollar/treasuries are no longer viewed as the safe haven, you're looking at game over USA.
Yeah.
And Danny, the reason it's game over USA is, what are we hearing now? That the next 4 years, the debt is going to increase by 10 trillion. That's a disaster. And what that means is we need to borrow 10 trillion just to keep the doors open.
Yeah. Yeah. Speaking of hedging disasters, I have the oil price here juxtaposed. I'll put it right beneath the gold price. So, all right. So you've got gold at the top. You've got oil here at the bottom. Now, over the last couple of weeks since we saw this Iran war start, oil got a significant bounce up from, I want to say, what is it, $61 all the way up until, 75 or so. I think it hit as high as 77 at some point, right? And gold, if you look at that same time period, it had a more subdued rise up. It wasn't really as impactful as the oil price. Why do you think that is? Why do you think gold didn't get as big of a bid despite all the geopolitical risk ongoing?
Just because of the level that it started from. Silver was slightly oil was slightly oversold, and gold is slightly overbought and deserves a break. I mean, to see a pullback to 3,000, 3,100, that should not raise any eyebrows whatsoever. I mean, it would just be a relaxing of that market and working the overbought off. So I just view it the percentage moves, oil should go higher on a percentage basis just because it was not overbought to begin with.
Right, right. It's kind of like a coiled spring in a way, but took a huge dump down from 75 down to 65, $10 haircut within 24 hours of this thing coming to an end, seemingly for now. We'll see.
It's a nice picture, Danny. Danny, it's a nice picture and a nice narrative.
Yeah. Yeah, it certainly is. And then at the same time, let's go ahead and turn this off. Let's go ahead and hide all this stuff. You mentioned the dollar. Let's go ahead and take a look at the DXY. DXY is at 97. It's been dumping since the start of the year, since January, really.
Yeah, and that's a new low today on the dollar. 97.30, 97.40. That is a new low on this whole move for the dollar. So the dollar has not gotten a bid. And if you look with that chart right there, you see that how many years is that? 1, 2,
3.
Yeah, almost 3 years. You can see the bottoms in that sequence. You know, at bottom we get a bounce, at bottoms and we get a bounce. This time we've broken through that support, and it tells me, you know, you've got downside to find another support level from here.
Right. So yeah, there's
that. Of course, Danny, we're talking, you know, technical numbers here. In today's world, as I just mentioned, you know, you wake up one morning to a disastrous fundamental event, and you could see the dollar quickly in the 80s.
Yeah, for sure. For sure. Things are moving quite fast, especially with the free flow of information. Let's go ahead and take a look at the 10-year. The 10-year is at 4.3, the 10-year yield, that is. So bonds are getting a bit of, it's kind of strange, really. Why do you think bonds are holding fairly steady while the dollar is getting hammered in the international market?
Well, you've got some foreign flow from a fear standpoint. But I think rather than looking at the noise right now in that market, I think it's important to understand that the last big event was the Federal Reserve cut once or twice or 3 times. They cut a full 1 percentage point. But if you make that chart go back further, you'll see that from where the Fed started cutting rates, interest rates on the 10-year Treasury or across the board really on the yield curve are up 1 full percentage point. So the Fed cut rates 1% and market rates went up 1%. That suggests to me that the Federal Reserve is losing control of the yield curve.
And what's fascinating about that, I'm glad you brought this up. What's fascinating about this, here's the long-term view of this chart. Going back to the 70s.
Right.
And it's long-term resistance. And then this circled portion here is when the Fed started cutting rates back in mid to late 2022. Boom, breakouts since then. So they have indeed lost control.
I think so.
And what does that mean moving forward?
I mean,
did they do yield curve control, do you think?
I think they'll try anything and everything. And I think they understand that they've lost control. The problem with losing control is, and I mean, Trump has said it himself, he wants rates lower so that the amount of interest paid on the debt is lower. But what if Mother Nature actually does take charge and there all of a sudden is some risk premia to the yield and yields are 2 points higher than they are now? How does the government keep the financial doors open if they can't borrow?
Well, you remember Besant's North Star at first was the 10-year yield, right? Remember his comments on that? He says we were focusing on the 10-year yield. In January is when the Trump admin came into being. So this was around here, and the 10-year yield has been pretty much at the same level. It hasn't really changed much. So is there anything they can do to impact that?
I don't think so. I think it's the cake is already baked and it's about to catch fire in the oven. There's really nothing they can do. I mean, they want lower rates, but you can't have everything. You can't have lower rates and a dollar that doesn't collapse.
Mm-hmm. Who do you think is more so in the right here? Do you think it's Powell or Trump here? Is Powell being more responsible, or is Trump being more responsible? If you where do you see it breaking eventually?
Well, in my opinion, on this subject, they're both idiots, because you're talking about an unbacked fiat currency, the dollar, which is the base of all of this. And the bottom line is the dollar is intrinsically worth zero. So I think they're both wrong. I mean, it doesn't matter whether rates go up, down, sideways. The bottom line is they no longer can. They don't have a collar on interest rates anymore. They can't control interest rates. And that's a problem to the U.S. Treasury, because they continually have to borrow. I mean, just on this big, beautiful bill is going to increase the debt by $10 trillion in 4 years. And it all goes back to Richard Russell's inflate or die. Either they can get the system reflated again, or it's completely over. You'll see a debt implosion.
Well, Elon gave it away a couple of weeks ago in a tweet. I don't know if you see. I think you probably saw it.
He did. Yeah.
And he basically said that it's pretty much hopeless. Our only solution is to just just put all our eggs in growth and try and grow our way out of it.
Right.
So literally a Ponzi scheme.
100%.
And if you were a betting man, would you say that we can in fact grow our way out of it?
No, I think, and I've said this for years, the final episode is going to be a massive deflation of the things we have and a massive inflation of the things we need to live on a day-to-day basis.
So rising commodity prices, sounds like.
Well, rising commodity prices, high inflation, high unemployment. It's going to be the worst of all worlds, because the world for so many years has been masked, if you will, to show a narrative all is well. But they've done that with derivatives to price various different markets. And now the pricing mechanism, I mean, markets are so far out of whack as far as relative pricing. There's got to be a reset, and that's what we're headed for now, is a man-made reset, which I think will fail, and Mother Nature's reset is going to be extremely severe.